Hi, I'm Bill Baruch, president of Line Captial, and I'm here with our analyst, Jannis Meindl, for another episode of the Triple Play podcast. Thanks for joining us. We're concluding a pretty big week. We got a very strong day setting up here in the equity market. Still second half of the day to go, but big move after jobs, 339,000 jobs added in the month of May, with wages, not accelerating. I think that's definitely a good thing. That's what you're seeing here with the market reaction. Earlier in the week, we saw unit labor costs for quarter one revised down to 4.2% from something like 6.3%. The market's found that very favorable. Now we're seeing other wage data where the month to month from last month was revised down from 0.5 to 0.4. So this month, May's month to month is only 0.3 when they're looking for 0.4, and really a smaller jump from a smaller number, from a smaller base. I think the market's finding that favorable, as well as the unemployment rate at 3.7%, up from 3.4%. It's the highest, I think, since December, maybe. Now, the dollar is also moving higher and rates are moving higher. So it's going to be a very interesting environment going into next week. We have ISM, non-manufacturing, the services read to start the week off on Monday. And that's been the real strong sector. But when we look back, the manufacturing data from ISM this week showed a contraction within manufacturing. Very slow. The prices and the new orders, those were contracted pretty heavily. However, employment continued to expand, even the manufacturing. And Jannis, I'll hand it over to you. You pointed out something really nice within today's report.
Absolutely. So strong jobs report, of course. Don't forget that also last month's number, April's number, was revised higher by 41,000 jobs. So not only strength in this number of May, but also previously the April number. And then something we talked offline about is the construction sector, which is, of course, keeping a close pulse on the economy and how activity is looking. That expanded by 25,000 jobs after adding 13,000 jobs in March, and actually shedding 9,000 jobs in March, 13,000 job additions in April. That was so a lot of strength as far as the internals go, and all of that is happening while wage growth, which would theoretically be the main concern if it accelerated for the Fed, that is also not accelerating to the upside. In fact, it's decelerating, and you highlighted the revision lower from April. So a lot of encouraging trends within the data, despite short openings ticking back up. We see that this is not really spilling over into wage pressures to the extent that a lot of people might have feared coming into this strong headline read. So a lot of the trends that we've been talking about on this podcast, Bill, you've talked about it at length in your Market Minute spots on TV, elsewhere, is playing out right now, and we'll keep you posted on how we're playing it.
Yeah, and kind of conclude it all. The CME's Fed Watch tool has a about a little better than 30% probability the Fed will hike 25 basis points at their meeting in June 14th. The theme this week has been skip, and some of the Fed members, specifically the incoming nominated vice chair Philip Jefferson, talked about skipping a meeting. You also had Harker, Philadelphia Fed president, who's a 2023 voter, talked about skipping a meeting. And Nick Timiraos of the Wall Street Journal, he did tweet out this morning after the report, that those that think the Fed should hike again are probably going to still stay in that camp, and those that think the Fed should skip a meeting to assess are likely to stay in that camp. I don't think we learned a ton from today's jobs report. So that's kind of where we find ourselves now, heading into next week with services, and then it's a quiet period here from the Fed that begins tomorrow. So I don't know if we'll hear anything today from any further Fed comments before the end of the day, but keep an ear to the ground. But as it looks, stocks are looking for a strong close to the week. So let's get to it. We're touching on cybersecurity this week, and this has been a great time of the quarter too, because this is about right when they report. We've had Palo Alto, I think it was 2 weeks ago, Crowdstrike 2 days ago, and now we have Zscaler last night they reported. Zscaler having a strong session. Palo Alto breaking out though. So let's start there. This stock breaking out to new all-time highs within the trend. Now this was a very high multiple, 322 down to 44 after reporting. That's really strong to see. The fact that it's breaking out, the multiple is decreasing. The earnings are showing up. That's terrific to see. Now, free cash flow margins accelerated in 2022, 32.6 2022 to 37.9 in 2023, before rising again through this fiscal quarter to 38.3%. And so the free cash flow margin is a great tailwind for business. Revenue expected to slow, though. And that's been the theme where we've seen these revenues slowing, but that's where what became priced in last year. And so that's where the market's expectations are already narrowed into expecting that. But that's something that's very interesting. Where we have the free cash flow, I think that could be something that's a great anchor here for this breakout. Now when we dive into a name like this, let's see here. I had some notes. Now, the strong secular tailwinds behind the endpoint security, their competition, though, could slowly become these larger tech companies, not just CrowdStrike, but as we move down to not just Palo Alto, but also CrowdStrike and a Zscaler. You look at names like a Microsoft that are creating their own cybersecurity offering, and it's going to be a larger and larger competitor as some companies package up entire enterprise software deals that could include something like that. But for now, it's Palo Alto that is really separating itself, that these larger tech companies are less of a competitor now, because Palo Alto also offers more of a hardware offering. The endpoint security, cloud security, and convergence of network security, it's continued to expect it to grow, and that's been a huge tailwind for this company. Now, but again, we can't ignore these potential large tech companies and where they can go with things, as they're all, not just Microsoft, but everybody is getting their hands into the cybersecurity space. Now, you also have the recurring software revenue that CrowdStrike has been able to anchor on. So even though they have the hardware, the recurring software is continuing to grow and be a larger part of their business. And the overall macro trends have been a tailwind for the space in general. You look back to as far back as the work from home, people in moving out of the office, it increases the need for cybersecurity through the cloud. Then you look at Russia invading Ukraine, the added security, the hacks that were taking place the last year. It's going to call on these companies more to be integrated in the day-to-day business operations. I think that's something to really lean on here. But the question remains, how much is baked in? How much was loaded already, front-loaded from those expectations? Now, you look at a name like CrowdStrike and Zscaler, which we'll get to, they're still at the very low end of the range. Palo Alto is breaking out. They offer the hardware. They're a little bit of a different offering than the other names, and it's a leader within the space. Jannis, what do you have to add here for us?
Yeah, echoing all these points that you had mentioned, with Palo Alto Networks, one big trend and one big thing that they've been the beneficiary of is that they have a wide product portfolio from software to hardware. And that's ultimately why they have seen those large contract offerings, which they have really been able to capitalize on. If you are a corporation, if you are a small and medium business, then you're looking for a service provider that can offer you the entirety of the cybersecurity stack, meaning the hardware and the software integrated. One of the aspects where they've shown a lot of strength is really the $1 million plus, $5 million plus type contracts, where most of the strength has been. So that clearly shows you that their customers are looking for a service offering that is entirely integrated, and that's why they have been able to capitalize. They have left little doubt that the ultimate trend is definitely more software heavy, and the trend is away from the traditional hardware offerings that they still have in their portfolio, but they see that trend ultimately flowing towards software, and that is also where the margin dynamics come in, because ultimately these software offerings are based on recurring revenue, sort of this SaaS type model that they have there, and that should sustain margins in the future. If we look at cash from operations as a percentage of revenue, or free cash as a percentage of revenue, that's staying rather stable here, expected for 24, 25, 26, and even in 2027, where analysts expect this uptick or that steadiness, maybe despite some weakness here in the enterprise spending. We've talked about the weakness in enterprise spending across the board, but despite that dynamic, Palo Alto Networks has shown a strong ability to ultimately sustain and expand their customer base. So a lot of the themes across these names are quite similar. The real differentiator here is that Palo Alto is able to offer a broader product portfolio to their customers.
That's they're leader in the space. That broader portfolio. Again, I can't emphasize enough as you can have the competition grow from these large tech companies. Palo Alto. That's why they're breaking out. That's why they're separating themselves from the rest of the pack. To finish off the chart, I mean, it's pretty straightforward. I will say a lot of these names they held on this weakness. They held the pre-2020 breakout, and Palo Alto not only held that, held the 2021 spike. But yeah, it's a terrific move. Very well held support, break out that downtrend, consolidate. Now it's breaking out, and it looks phenomenal. So as long as it's trading above there, it's a name. We haven't owned it, and the question has always been for us, how much is front loaded in for 2020? How much is front loaded in, and then after the war that started? So it's a name here that tactically it's very bullish. It looks like so. It's on our radar. We'll probably find a way to fit into the portfolio at some point. Let's move on to CrowdStrike. Now, a very much higher multiple here, 69.2. And that is down from, though, a negative. I mean, a no multiple. They were negative 200. So they now have a positive multiple. They're making money. That's a positive. They ran up in earnings. They were down 10% yesterday's session on Thursday. And they actually made back to basically nearly unchanged. This information will include that report. Fiscal year 23 of 31 free cash flow margin. 23 is 31.5%, will decelerate to 29% before re-accelerating in 2025. Now their fiscal year, quarter four, so they just reported quarter one of 2024. Now, so this second quarter of what we know is the second quarter is their first quarter is their first quarter fiscal the following year. So when they say 2025 to re-accelerate, they're looking at quarter two of 2024. That's really when we start talking about these themes of reestablishing revenue growth and a lot of these companies being earmarked to those 2024 expectations. That's what we're talking about. A lot of these fiscal years are already starting to come into there. We talked about that with some of the semiconductors recently too. I think that's a good tailwind. They've mentioned AI. I mean, they've got a foothold in the AI space. That they look at that as an advantage. They're threefold: AI, consolidation, and cloud is the three mega trends, and they're leveraging AI. I mean, that's ultimately surprised we didn't see much of a bigger move out of the earnings. I mean, given some of these AI comments. And then the other thing that's really interesting is they're closing bigger deals. So over 50% more deals involving 8 or more modules compared to a year ago. And so they're closing the bigger deals is a big thing. And they're better at a better price point than a place like Microsoft. So even though Microsoft's going to grow more of a direct competition to CrowdStrike and Zscaler compared to Palo, but the cost efficiency is much better with the CrowdStrike. Some comparisons that the CEO had talked about from some of their clients and how that would it would cost much more to make a transition to Microsoft and whatnot, and even to consider Microsoft as if they were a new prospect. So that is still the advantage is the cost-effective solution within CrowdStrike. And then it remains the secular trend. Endpoint security just continues to grow rapidly. Again, how much is this front-loaded? That is our concern. But the headwind being that potential large tech. So what are you seeing here, Jannis?
Yeah, you touched on for some of these mega trends. I mean, CrowdStrike was really one of the first players in cloud level cybersecurity on the endpoint, and they should have theoretically a data advantage. They talked about that at length on their earnings call, where more data means they can detect more threats, and ultimately the accumulation of information that they have as a result should benefit the cybersecurity across the CrowdStrike network, across CrowdStrike customers as a whole. So they should have an advantage there. One of the things that I want to touch on is this potential competition from players like Microsoft. CrowdStrike talked about them in terms of not really being a direct competitor at the moment just because they are more expensive. But one of the things to consider there is that probably is someone like the Microsoft, someone like the Amazon or an Alphabet. They really designed the cybersecurity solutions for their own internal applications, like Microsoft running Microsoft Azure, the cloud provider, or Amazon running AWS, Amazon's cloud provider. They've really just tailored these cybersecurity solutions towards their own products. So up until right now, one would imagine that first priority has not been to ultimately provide these solutions to third parties. So CrowdStrike mentioning right now that they are more expensive might be because they just have not made that a priority for the time being. So at the point that that becomes more of a challenge, you definitely want to pay attention to that. Last year, Microsoft's cybersecurity business was roughly 10% of revenue. So any sort of expansion there, if they lowered price and they were going to compete with CrowdStrike, that would probably become a larger share of the revenue pie. If you look out towards a couple of years here, then you can clearly see that the market still expects CrowdStrike to remain more of a growth story. You can see that revenue growth towards 2025 is expected to be higher than cash from operations growth, meaning that the market right now is pricing that CrowdStrike remains a growth company. And then if you look towards 2027, the cash from operations growth is actually set to outpace the revenue growth. So a little bit more of a margin story at that point. So you want to watch that transition from being a growth company to a little bit more of a focus on margins. So those were really the main dynamics that I think are relevant for the stock.
And then you'll see here as we get to the chart, it's very not as constructive as a breaking out, of course, but it's going to be very similar to Zscaler. Now, it held a pre-pandemic high, very constructive low, broke the downtrend line, starts to accelerate. Now we're moving into 382. I've talked about this before, where downtrend, new stocks would hold the 382 retracement and then resell off. So this is a pivotal level here. As moving into that previous lows, the 382 retracement. Can this sustain higher prices, and can this really kind of get out above and then really start repairing the damage and kind of move forward? That's going to be the question going forward with that. And Zscaler, as you see here, let's move on. We'll have very similar chart pattern. So Zscaler reported yesterday. We don't have their data up to date here, as we were actually going to shoot last night. Then we kind of got tight on time, but it's up 9% today. Big move in the market. It's multiple at 75 coming into that report. Trailing 12 months is negative 59. So you're starting to see this trend. They're actually making money now. They're positive multiples. Free cash flow margin expected to slow before reaccelerating in 2024. So same sort of story. The fiscal year, they're going to get some reacceleration at the turn of the year. Now, for the quarter, their group revenue 50% year over year, though billings grew 34%. Now, this again going back to the report in March. Now, impacted by new customers being more deliberate about their large purchasing at the start of the calendar year. So you're getting these larger purchases early. What does that do potentially for the rest of the layout? But you know what? I mean, the stocks is performing well here today. I think you're seeing that being a strong narrative. In their market leadership in high enterprise penetration through its offerings related to the secure web gateways and zero trust network access. So they are a leader within the high enterprise. And again, the big tech like Microsoft is going to be a competitor for them. So that is going to be the continued theme here that you can't ignore with a lot of these. And I'm sure it had some hand in the suppression of these prices. Now they also face competition not just from the Microsoft, but Palo Alto and a Fortinet, as these companies have made more software-focused investments. Like we talked about Palo Alto shifting a lot of the revenue from reoccurring software streams. It's going to weigh potentially on a Zscaler too. So some of these older, trends that they've had are going to be, potentially shaken a little bit. The tree's going to be shaken. That's we got to keep a close eye on. What are you seeing here with the Zscaler, Jannis?
Yeah, so I mean, one of the smaller players in the space, and as you correctly alluded to, they're not only facing the competition from the players like Microsoft and the big tech companies, but also from Palo Alto Networks and the other players that are really shifting the focus towards more software related products, which Zscaler's real expertise has been thus far. So as Zscaler has to keep investing, they have to maintain their sales force, they have to stay up to date on the software they provide, because nobody will want to have outdated cybersecurity, or else you might just want to go elsewhere if you were a customer. So these are all secular headwinds for the stock, especially as it's a smaller player in the space that's still not profitable. So markets will also watch whether they can maneuver a path towards break even here on the net income side, and not only focus on growth, because all that growth comes at the expense of making more investments, staying up to date on their cybersecurity stack. So this will definitely be a challenge for them to make that transition. Maybe there's ultimately a buyout story to be had given the customer penetration that they already have, but Zscaler is really running on two main products. So the smaller you are, the easier it probably is to get disintermediated by some of these larger players, especially as the mega cap tech names become more of a competition, but also with the existing players not going anywhere at this point. So watch this revenue story, watch the free cash flow story, and ultimately, can they become profitable in the midst of this?
Yeah, that's a good point. Great point there. That's what we watch. We watch the revenues, is it accelerating, the deaccelerating? What's the free cash flow story look like, and how does that multiple comparison, as the stocks perform? Now they have some more room to run here. I mean, this is a bit more room to that 382 retracement. Maybe this is a little tailwind, especially the broader market's moving higher. You got Palo Alto breaking out. It's going to get up to that 200-point mark. That's going to be the battleground. Is it going to stay in a bear trend for this stock, or is it going to begin repair of the damage from that fall from the clouds it had? Well, that wraps it up. I mean, I think it's a very interesting space. Again, one of our fears was how much is front loaded from those two massive events we faced in the past few years is in the cybersecurity space, the work from home trend, and the need for more cloud security, and then the Russia invasion of Ukraine, obviously it was a big tailwind last year early for these names. So thank you for joining us. If you have any questions, don't hesitate to reach out to us. You can connect with us on our website, BlueLineCapLLC.com. You can see that there's a great chart book on there. Jannis does a terrific job working on that chart book, so check it out. But we'd love to hear from you. Please connect, and thank you for listening. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.